welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
There's this theme that we've been talking about for a while, Eric, and you've been wanting to do it. I've been resisting.
So I don't know how many episodes we've done, maybe 200.
We should actually count.
And there's probably only like 40 categories of ETFs, meaning we've covered many categories multiple times, but we've never covered this one.
Yep.
Because
of me.
Yeah, well, and I understand. It is arguably one of the more boring sounding categories.
Yeah.
I mean, I would put it right up around short duration bonds.
Have we done that one?
We have.
Oh, see?
Yeah, because money markets. This is municipal bonds. Now,
hold on, I'm going to fall asleep.
Before people tune out here, listen, a couple things. First of all, one of the most read analysts in Bloomberg Intelligence is Eric Kazatsky, my colleague. I've known him for years. And he's a very colorful writer, too. And people really use munis, especially if you're planning a portfolio for a real person. The after-tax yield on these bonds is great. I remember interviewing Jack Bogle, and he was a big muni guy. He loved munis for his portfolio. And when I look at some of Eric Kazatsky's headlines, what I like about them is they're so tangible. LA fires, Texas battleship, JFK airport, the Hollywood strike, DeSantis and Disney. There are muni pegs to a lot of stuff that we love and know. So I think
America is built on the municipal bond.
It really is. It runs on munis, basically. So we are going to try to get...
In other words, a long overdue episode.
We're going to try to make munis cool today.
Yeah.
Okay? That's our attempt. I'm going to try to keep you awake and riveted, and Eric will too.
I'm in.
Eric has the bigger job, though.
I'm so ready. And joining us on this episode, Eric Kazatsky, an analyst with Bloomberg Intelligence, who's also the co-host to the podcast Masters of the Muniverse. This time on Trillions, Muniland. Eric, welcome to Trillions.
Hey, I'm happy to be here. And what a setup. I wasn't sure where that was going at first, but you guys turned it around at the last minute. Thank you, Eric Balchunas.
You know, as Balchunas set up here, long overdue conversation. So why do investors like municipal bonds?
I mean, it's really simple. Do you like paying taxes? I don't like paying taxes.
Okay, so why are they so boring?
I think because people are confused by them. But look, at the end of the day, it's the simplest thing to understand, right? Hey, look, you live somewhere, has a school. Undoubtedly, that school was built with tax-exempt bonds. You have been to a sports game lately, a concert? Undoubtedly, those have been built with tax-free bonds. Airports, roads, bridges. It's just the easy stuff you see every day that gets ignored the most. That's really what it comes down to.
Okay, so there's this tax exemption that munis benefit from. How does that work, and why are they exempt?
Yeah, I mean, well, so it's been tax law for almost 100 years. I mean, the market has been around that long. But essentially, what you do is the issuer gets a benefit to borrow at a lower rate, and that's passed on to the buyers of those bonds, and they get to save the interest that comes in as income from their federal and state taxes. Now, it doesn't all work the same. Some states have different laws, but let's just assume that they're all federally and state tax-free. It's just simple for this conversation. So, look, it's a double benefit, right? The issuers get the benefit of borrowing lower, and the investors get the tax-free income. It's really as simple as that.
Real quick, okay, let's just bring one up here. The iShares California Municipal Bond ETF, CMF is the ticker. I have a yield here of 2.8%. So what is because when you talk munis, people talk about after-tax yield. What would be the tax equivalent yield? How much more do you get if you lived in, say, California?
So we use the rule of two here, right? Just figure in these high tax states like New York, New Jersey, California, just double the yield. You'll probably get pretty close because, the highest tax bracket in California, you're looking at like 13.3%. You add in federal taxes, Medicaid, you're up near 50%. So 5.6% on a taxable equivalent basis.
That's pretty cool. See, they don't put that in the data.
You need Eric Kazatsky for that.
You do.
Yeah.
Eric, I need you for something else here, which is why is that tax exempt status potentially at risk?
Well, it really comes down to the returning president. He has a mandate in his mind to roll out extensions of the Tax Cuts and Jobs Act. And look, it's going to cost anywhere 3.5, 4.6 trillion. I don't know, pick a number, any number, but you need a way to pay for it. And every election cycle, it comes up that, muni bonds are going to be at risk. And I think it really comes down to the fact that people assume that those people who are buying munis are sitting around with top hats and monocles, just smoking cigars and enjoying all this tax-free income. But if you look at where the money's going in munis, I'm sure we're going to touch on this, it's going to ETFs, it's going to SMEs. And these are low-cost, low-dollar fee structures that are attracting people not in the highest brackets. So, that's really sort of where the risk comes in. It's going to impact everyone.
So just to be clear here, nothing is happening yet, but it's just
Correct.
Part of the chatter about the Trump's tax cuts, which will become a conversation this year since he's back in the White House and has control of Congress, and those tax cuts are expiring at the end of the year, right?
Yes. So the House Ways and Means put out a wish list, 50 pages long, and the muni exemption going away was one of the items on there. But another thing you need to know about people in Muniland, we love to be part of the current news cycle, and this is just another way for us to sort of pop in there.
Not to be boring and be part of the
yes.
moment. Yeah.
Yes,
I actually
exactly.
think I tell people that all the time. It's like, give me a headline, I'll show you the ETF peg.
Yeah.
And I like that too, Eric. Well, let's go to the LA fires. Explain to me the muni connection here, because I saw you had a note that, again, his notes do really well readership-wise. So
Los Angeles fire is just another instance of nature just wreaking havoc on our market. Look, every year you got hurricane damage in Florida. Inevitably, it's hitting areas where, people are paying taxes. Those taxes support general obligation bonds. Hospitals, colleges, things are impacted by these weather events. And unfortunately, California, it really sort of got out of control with this sort of unseasonal fire that took everyone by surprise. By the numbers, we sort of calculated that there was potentially about 70 billion of, muni sort of tangentially related projects at risk. What it's actually going to shake out to, too early to tell still. But look, the totality of the damage certainly caught a lot of people by surprise.
And what does that mean for bondholders?
Hopefully nothing, right? We want to be benign and in the background, and we want to sort of keep on with the, adage that there's never been a true muni default from an act of God. We haven't seen one yet. I don't really think you're going to see one here. It doesn't mean there's not going to be litigation that's going to be painful, especially for LA Department of Water and Power. The Water Department is already smacked with the lawsuit. Not sure how it's going to play out, but they could have some liability, right?
When has there been defaults? What would cause one?
Well, you have defaults as far as Puerto Rico, as far as Detroit, and New York back in the 70s, right? It really comes down to bad fiscal management. Bad fiscal management has caused more issues in Muniland than weather and nature-related events at this point.
So do you cover that? Like, do you look at where maybe the code red situations are, where there's like total mismanagement of funds? I don't know why I keep thinking of Illinois. Like, are they like in that sort of...
You're right to think that.
Yeah.
Look, we try and turn on the lights and see where the cockroaches are running as much as possible. But, the problem is these are slow burn things, right? Detroit played out over years. It wasn't a new issue. Puerto Rico, same thing. Certainly Chicago Board of Ed, Illinois, they all have their problems. The problem is they're able to kick the can down the road. We just try and stay on top of it and tell investors sort of where the risks are.
So let's talk about practical application. Let's say you have a muni portion of a portfolio. The two biggest ones on the market are MUB and VTEBs. That's iShares and Vanguard. Those have like $35 and $40 billion. They're the studs, like most categories. It's like the big two have the top ETF. So should someone just buy one of those and call it a day? Or like, what does a muni analyst think of those two sort of big timers?
It's like vanilla ice cream. It's great. It's a fine flavor. It's a top seller. But like you can only have so much of it, right? Everybody wants some variety. And that's the beauty of the ETF market, is that it's bringing in a lot of alternative flavors and small boutique ice cream providers, let's say. MUB and VTEB are great, right? Measured by flows, they're the biggest creatures sort of like roaming around Muniland. The problem is they miss a big portion of the market. They're passive, which is not a bad thing, but they don't invest in hospitals. They don't invest in higher ed. They don't invest in bonds that are subject to alternative minimum tax. We wrote a note earlier in the year. They miss about 18% of the investable market for munis, just based on their sort of stringent criteria. And unfortunately, that 18% makes up a big portion of returns in every single year. So I think investors are missing out, right?
I remember back, 5-6 years ago, MUB was the big category leader by far. Then Vanguard launched one, started climbing the charts, VTEB. And I remember MUB, I think, was 25 basis points. Vanguard was like 6 or 7. And MUB slashed its fee in one shot from 25 to 7.
Whoa.
And I thought, that's why I call it the Terror Dome, Joel. You're the leader of the category. Most volume, most assets, but you know what's about to happen. And you basically cut off both legs and an arm. I've never seen self-cannibalization that great, but they're still number one. It worked. I mean, had they not done that, I think VTEB's 3-4 times bigger. So that's also something, Eric, just before we get to the unique ETFs, the muni mutual funds, they're all active, right? There really is not a lot passive there. And here you have 2 ETFs at 5 basis points each. How much does that factor into all the money that's rushed here, given that most mutual funds are like, 80 basis points to maybe 1.5%?
It's factored in a ton when you think about who the majority of folks are buying this thing, right? You have a lot of retail people just directly buying, but it's also part of platform investing, right? So if I'm an RIA, I'm charging 1% on a portfolio, and I can go from, let's say, splitting a 30 basis point fee with a mutual fund and keeping 70 to keeping 95, and I have 5, for investing in MUB or VTEB. That sounds much better to me. Right. My clients are probably like none the worse off as far as exposure. But I think, again, 2 different styles, right? If you're worried about performance, you may not want to go down the road. If you're focusing on just asset allocation and fees, they're certainly the most attractive thing out there.
Okay. So hot sauce has come for every ETF category I can think of. What does hot sauce in muni bonds look like?
So, one thing that was launched very recently was SPDR has target maturity muni bonds. So, for example, it's SPDR SSGA Mai 2028. So that's a niche version. So that means all the bonds mature in that year. That way you can time your duration a little bit. We've seen some other things launch like tax-aware muni bonds, a lot of short duration muni bonds, high yield. I know high yield, Eric, was one that back when COVID happened, Eric and I talked a lot because there was an ETF, HYD, which is the Van Eck high yield muni. And this thing traded at like 20 to 30% discounts to NAV. And of all the bond ETFs, this was the worst in terms of it obviously held the least liquid stuff, that its price was deviating that much from the NAV, although the NAV was based on old bond prices, so it was stale. And it's interesting, that ETF, even though it was it turned into a closed-end fund essentially, it's took in more assets since then, and the volume's the same. So it seems like people know how to roll with that. But Eric, what's the liquidity like in this scene? Like, is a high-yield muni bond ETF like something that's for normal people, or is that something that really just traders should use?
No, I think there's a lot of liquidity, right? Look, I mean, what happened in the early days of COVID, I feel like is a complete anomaly, right? And I think the market's a lot more prepared from a market structure standpoint than it was in 2020. A lot more things have changed. So let's say we had a sharp sell-off again. I think the folks who are running HYD, if I was them, I would imagine they have a much deeper IG basket of bonds to throw over the side of the boat if there's some sort of like sharp correction than there was back then, right? Just to sort of like hedge against that. But look, I mean, I think the fact that this market is really sort of like, if you think about it in terms of the fund companies are going to go to where the puck is, right? And they're all skating toward high yield, active, sort of restructuring the old mutual funds, wrapping them in an ETF wrapper. That really is sort of the play of the day when it comes to the muni space right now. And we're seeing sort of that play out. And the fact they're all crowding into the high yield space, it means that they still see an opportunity there. What's going to be interesting to see if the market responds from an issuance standpoint to sort of keep the lights on and keep the supply going to feed all these new projects.
It's interesting, Joel, 141 billion in this category, 23 billion active. But active makes up the majority of the number of ETFs. So in other words, active is a lot of the new launches, a lot of the supply.
And we know that active has been coming for fixed income forever. So that's not surprising. Maybe not forever, for the past couple of years. As hot sauce goes, I don't think that that's very spicy, Eric.
I don't know. I mean, HYD, I'm not sure it gets much spicier than that. There's no leveraged muni. I don't think
this is as spicy as Muniland gets?
Yeah. And I think that's part of why sometimes we don't look at it too much. Like, it never jumps away. That's why HYD at that time, I called the canary in the coal mine, because it was trading at the deepest discount. But one thing I thought about this space, Eric, is this idea of like how to jazz it up a little. Because when Eric talks about, and his headlines, it gets my brain going better than when I look at the names of the ETFs. For example, how come they don't come out with hospitals and schools? And because in my opinion,
I'm kind of into those.
Reality, right? ESG.
Those are the things I know.
Yeah, it's like better than ESG, because like I'm going to invest in this and I literally know it's going to go to stuff that I like and want to support, versus ESG where it's like, let's take out this stock even though it's not that bad, whatever. I don't get why they don't play with the names.
Yeah, focus on the tangibles.
And do more tangible stuff and thematic. It's weird to me they haven't done much there.
Or like
with that.
Buy LA. Or like seems like you could get behind that.
Yeah,
What's
help LA.
Exactly. I don't disagree, but it's interesting. Someone probably paid a lot of money to come up with these really snazzy tickers on some of these, and unless you know exactly what they're doing, you don't get a lot. One of the ones I'll point to, and we talk about hot sauce. I mean, look, I disagree. I think there is leverage to be had in the muni ETF space, and RTAI is a perfect example of that, right? When rates were jumping up, this is one of the worst performers. Rates eased off a bit last year. It was one of the best performers, and it's one of the most levered muni ETFs out there. 1 year returns almost 11%.
Okay, so this is just so people don't let me play the name of it, because I actually didn't know this one. Rare View Tax Advantage Income ETF. Yeah, that name is boring. I got to be honest with you. And you're saying this
Total
has leverage in it.
Yeah.
How much?
Yeah.
What percent? Roughly?
I think it's up near like 30 to 35%, just sort of back of the envelope. I'd have to double check that.
Oh, yeah. The yield is 5%. That's pretty, especially if you get an after-tax yield of a little more than that.
So there is spice.
It's okay. Like I said, it's all relative.
Right.
This is spicy for
the ghost pepper of Muniland.
Well, oh my God! Let me look at the volatility here.
The banana pepper of
by the way, the volatility is still half the S&P. That's spicy over there. Okay. All right. Yeah, it's like a kiddie ride in the equities.
Yes.
Okay, Eric, I want to bring this back to this threat that seems kind of existential. Like, if already it's really hard to care about Muniland for a certain investor, or at least one named Joel, and this tax exemption goes away. How existential does that make Muniland?
Think about it this way. State and local governments still need to finance billions of dollars a year to keep the lights on, right? Keep things in good repair. And so if the exemption went away, it just means they're going to be borrowing in the taxable market at higher rates. I don't think they're going to be borrowing where like Apple or Microsoft issue, probably somewhere below that, but significantly more than they are now. And guess what? They're passing that cost on to you. They're passing that cost on to Mr. Balchunas. They're passing it on to me. And I think that's the underappreciated point here, right? We all sort of benefit from that collective subsidy that's being issued for the top hat and monocle crowd, if we sort of want to go back to that analogy. But we're all sort of getting something for that as well. And it's less taxes than it could be. And I think that's sort of the point to really sort of hit home with those who are making the decisions in Washington.
Man, the lobbying feels like it's going to be very loud on this one. It's going to be an interesting thing to watch, especially at this moment that we've got a MAGA crowd that's taken over, the Republican wing, and something like this seems like it'll be an interesting topic of conversation in the year to come.
Yeah.
Balchunas, any final thoughts?
No, I just wanted to kind of ask Eric, as an analyst who sees all these ETFs coming out, because sometimes he does cover the ETF side of things. Are there any sort of out-of-the-box ETF besides RTAI that sort of stand out to you as interesting, or something that that you might have designed yourself if you were an issuer?
One that sort of comes to mind, and it's selfishly, it's a shameless plug for Masters of the Muniverse. It's someone we had on not long ago, Rockefeller Asset Management, and they have a new fund, RMOP. What they're doing is they're getting really down in the weeds on the credit side of things. So like 21% of their asset allocation is in charter schools, which is sort of one of the, I would say, most esoteric areas of the muni space. And then their other export is airports, right? So they really have a blend of this really niche credit space and then something everybody's using. And I really sort of like that approach, right?
Eric, I've got one final question for you. It's a question that we often ask on Trillions at the end. What is your favorite ETF ticker?
My favorite one? It has to be HYD. I mean, and I only say that because, look, I don't want to give them a too hard of a time, but they were woefully underprepared for COVID. And I think it really played out in real time. But, I think the thing is, it brought so much attention to the fact that there were high yield muni ETFs.
Yep.
And I feel like that has sort of, in one way led to the growth of all these new products coming online right now.
And let me say one thing. Yeah. HYD in COVID, to me, is the ticker I bring up all the time, Joel, to explain that if you put private equity or private credit in an ETF, and it's like 15, 20% of the fund, let's just say that percent is illiquid. It probably still wouldn't be trading at the discount that was. In other words, no. I think HYD shows that you can have people have a hybrid closed-end fund ETF situation. They'd still prefer that than going to the mutual fund or interval fund. That's my theory on this and why it's okay and this will work. I use HYD all the time.
Yeah. HYD had to suffer so we can have nice things today.
Yes. I like that.
Right.
I may steal that for a headline.
All right. Eric Kazatsky, thanks for making munis not so boring.
Yeah, thanks for having me.
And for being a guest on Trillions. Long overdue. We'll have you back. Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.